Okay, so welcome to our second session here at Rasmussen. And today we're going to go over good work so far in the first group of work. I graded it, I gave you feedback. Please know that I added a bunch of my videos, which will definitely be a help to you. Just once again, you have the link to it in Blackboard, but if you go to the YouTube channel, there's a plethora of information here designed to assist you. So you go to playlists and you could go to, I have a Rasmussen, but that's a playlist with videos for this particular class, believe it or not. So you could follow up on videos that I have compiled for other class, for this class during other sessions. So that could be a help to you, no question about it. And then also, so please be aware of these. Also, close that down. And then we have a Statistics Academy, which is absolutely something you should at least peruse. We have Calculating Beta, which is something we're going to talk about today. These three videos on calculating beta will show you how to calculate beta in order to figure out the capital asset pricing model. We have weighted average cost of capital, which is going to be coming up. We have Understanding Standard Deviation, and these are all videos I put together for different classes. And then more on just stats, if you want to bone up on your stats, binomial distributions, Poisson distributions. I just added one on chi-square distributions. This is all stuff that comes into play when you're modeling. So I want that to be very clear that that's a place where I wouldn't mind seeing you utilizing it. I'm going to put it there to make and that's not what we want. I put this here to make life, easier for you guys, and it's my goal. It's my goal is that make this class as user friendly as possible. Going back to my channel, you absolutely want to take a look at the playlist that deals with finance. That's and so you're going to get all kinds of things that will help. Equity value models, time value of money models, some stuff on the bond markets, capital asset pricing model, which I sent to you for this week. I had sent it as part of your feedback, so you could start getting ready for this week. Even how to use Market Watch to put together some of this stuff is redundant, like the calculating beta, you can find it. I also have introductions to accounting spreadsheets and an interactive spreadsheet, which I think I put down, but if I haven't, I will. So you have a lot of information here at your disposal for helping you with this class. So I want you to utilize it. All right, so without any further delay, since we only have a limited time, let's get started on Module 2. And you're just started your new job as a boutique financial planning firm after graduation, and your manager asks you to review a portion of a client's stock portfolio to determine the risk return profiles of his 12 stock holdings. So this is a lead into the capital asset pricing model. So you determine the average returns, the monthly standard deviations, the average of the volatilities, and you calculate the risk reward. And remember, when we look at stocks, this is very important. We don't look at stock prices. Why? Stock prices cannot be negative. In other words, you can't lose if you buy a stock, it cannot go below zero. So since it cannot go below zero, it kind of skews the statistical references, right? Because now you have to cut off the like in a standard normal distribution, you're going to have let's assume, because a lot of this revolves around standard normal distributions. And once again, I urge you to look at my pieces on statistics, but in a standard normal distribution, right? I don't like that color. Can't see it. Okay, so in a standard normal distribution, right, we're going to have a negative side, and you don't get that. You won't get that in stock prices. So, okay. So how do we solve for that? We use returns. Because returns can go negative, right? We can have positive and negative returns. So now I've taken care of the standard normal distribution by using positive and negative returns. That's why we use returns and not stock prices. Intuitively, most people would say, well, use stock prices. No, we don't want to do that, okay? We want to use stock returns. So remember that in modeling. 12 stocks in this client portfolio, and they're in this spreadsheet. If you click it, I'm not going to do that right. Well, I could. I mean, it's not possible for me to do it. Let's call it up. And there are the 12 stocks, right? And by the way, and here's all your information right here. There's your efficient. We're talking about this. But by the way, I want you to, I absolutely want you to, open up the spreadsheet, take a look at how it's done, because it would be a help to you to kind of understand it and be able to see it practically. The one nice thing about an Excel spreadsheet, and I applaud the school for putting it in here, is that you can actually click and see how the portfolio was arranged and the efficient frontier. Okay, so good stuff here. All right, so let's keep moving. First, get the company stock information before you get started. For steps on how to download historical data, watch the video below. I'll show you an easy way to get data. If you're looking to do this at home, and I showed this if you watch my beta video, a great place to start if you don't have like a more sophisticated, and it's pretty sophisticated because I was on Wall Street back in the 1980s, and the stuff you can get now on for free is amazing. I mean, you couldn't even if you wanted to pay for it, you couldn't get it back then. Go to Yahoo Finance, and again, I have a video on this. Pick a stock. I'll pick Johnson and Johnson's having an issue today, right? The COVID, it's down 2%. Go to historical data, and you can arrange which data you want by picking a time period, and you can actually take dividends out if you need to. You can look at it daily, weekly, or monthly. And then what the beauty of this is, so let's say I wanted to look at Johnson and Johnson's data for the last 3 months, and I apply that, and I get the last 3 months, and then I just have to hit download, and I open up the spreadsheet. Just give me a minute. There it is. So very user friendly, and now I have the data. And I'm just really only going to need the adjusted close because that adjusts for splits and everything. Take that out. I don't need volume, at least not for my, if I'm going to look at liquidity, I might want to look at volume, but right now I don't need volume. And then I just need the difference in returns. So I could say this minus this divided by this. And there's my return, 1.7%. And I could also use log normal distributions, which we're not going to get too far into right now, but I can do that. Can do that. The way I would do it is not that way. I did it incorrectly. I would do this divided by this. That's my log normal distribution. Frankly, I could copy that, paste it, at the end of my data set. Beauty of Excel is I can do it for the whole data set. And I can go here, copy it, paste it. Now I've got the log normal returns. And if I want to go a step further, okay, now I have all my log normal returns. If I want to go a step further, I could go to data analysis, I could do moving averages, right? I could do moving average. I mean, you can get a lot of this stuff on a system like, you could do a lot of this stuff like on a system like Oh, okay. You could do a lot. I'm going to hold off. Let's look at descriptives. Let's do that. You could do a lot of this on on a system like Fidelity. If you have a Fidelity account, Charles Schwab, any of the trading accounts that are widely available will give you this stuff. So whatever. Why is this not happening? Oh, okay. We're going to look at summary statistics. That's all we want to see. And there you go. So there's our summary statistics for the last 3 months of Johnson & Johnson. There's our mean return. There's our standard error. There's our medium. There's kurtosis and skew. There's the maximum and minimum, and there's our number of data. So you can do a lot with this, and I'm going to continue to work on it. But that's how you play with it, and that's a good view as to how to get the information. The following steps below, and I just did this for you. You have to subtract 1. If you want to get the return, if you want to do it this way, new over old. I did new over old divided by old. And you can find it with average and standard deviation, or you can cut to the chase and do it my way. And just get all that over here. Now, how do you get that? Just so you know, and I want to say this again, for you working at home, you go to File, Options, and I think I showed you this last week. I might have. Add-ins, go to Excel add-ins, and pick the analysis tool back. Say OK. And you'll get the data analysis up here. Once again, you have to add it in. So you go to Options, Add-ins, Excel add-ins, and then click. You don't have to click on these, but you have to click on Analysis Toolpack. These two. Say OK, and you're going to have it right up here. It'll show up here. I have some other add-ins. And this way you don't have to do all these individual calculations. You don't have to do average and standard deviation. Average is the mean, right? It's all here for you. So do it that way. You want to make your life easy. Compare the average volatilities of the individual stocks. Use the variable.s function and use the S&P as the market benchmark. And this way you can compare. And you'll see that the volatility of a portfolio is 11.44%, and it's lower than the individual stock. So why would the volatility of the portfolio be less than those of the individual stocks? Right? Why would that be? Right? Why would the volatility of the portfolio be lower than that of the individual stocks? The reason is it's diversification or covariance. Because variance is what we deal with within each individual stock. But when we add other variances together in a 2-asset portfolio, we're going to get a mixture of different variances, and they cancel each other out. What does that mean literally? Literally, it means that you could put Coca-Cola in your company, right? The Coca-Cola company. What's the risk of Coca-Cola? Well, it's not really a risky stock per se, because if the market goes crazy on the upside, and you don't expect Coca-Cola to go just as high on the upside because there's only so much Coke people can drink. On the downside, we don't expect it to get hurt as much as the general market if the market goes down dramatically, because people are still going to buy Coke. It's a relatively inexpensive item in their budget if they like it. But one of the risks of Coca-Cola is the health crisis, right? No, a health crisis, a health concern. So later generations are more concerned about their health, and they may want to lower their sugar intake. So that's going to be an issue. But then I can buy a stock that deals with diabetes and helps in the diabetes, like a pharmaceutical drug. What I'm saying is I could keep buying stocks that balance out each other's what we call unsystematic risk. Because systematic risk is the risk of the whole market that affects every stock, a war, God forbid, or a presidential election, or a COVID. Those are events that affect every company. And you can't hedge those out. But you can hedge out the unsystematic risk. You can hedge out the unsystematic risk. So if we put 60% of our investment in Cisco and 40% in Apple, the expected return on Cisco is 9, the expected return on Apple is 12. Find the expected return for this investor. And I think it's here. I hope it's here. Let's see. There's Apple and Cisco. That's our two assets in our portfolio, Apple and Cisco. That's Apple and Cisco. Okay, oh, I get it. There's the returns, there's the prices. This is a great spreadsheet, by the way. There's the returns. They just basically did what I did. There's the expected return. So our expected return is going to be 10.2%, which is basically a weighted average of both returns. Now, the risk is a little different. The risk is going to be, and this is a very important equation, this is the variance covariance equation. We're going to take the weight squared of A, which we'll call it Apple, and this is for a two security portfolio. So we're going to take the weight square of A multiplied by the standard deviation. Whenever we see the sigma sign, well, it's the variance. I'm sorry. It's the variance. Well, hold on. Yeah. Whenever we see the sigma squared, it's variance. Whenever we see sigma on its own, it's the square root of variance, which is standard deviation, which by now, hopefully you have some statistical background. If you're still unsure about that, please watch my videos on it. So we take the weight squared of Apple times its variance, plus the weight squared of Cisco times its variance, plus 2 times the product of both weights times the correlation coefficient of A and B, which we'll talk about, times the standard deviation of both. And that is the magic of portfolio variance. By running these numbers, you'll find that the covariance of two individual stocks or two or more individual stocks will be less than the variance of the combination will be less than the variance of each individual stock. Just snip this for myself a minute. Be less than the variance of each individual stock. And why is that? Because exactly what I explained to you. It's the magic of diversification. By diversifying our portfolio, we take stocks that have different unsystematic risks. Coca-Cola with sugar intake. A pharmaceutical company, their drug may not work. An airline has oil prices. An automaker might have less demand because of the economy. But by blending all these risks together, they offset each other. So I could buy an auto company that sells new cars, and then I could buy a used car part manufacturer that benefits from people keeping their cars. Eventually, because of this covariance, I can blend out all of my risk. And you'll see by going back to our handy dandy spreadsheet, we can blend out our risk. That's the formula. And we could plot this on a curve. We could change the weights of one, and that will change. As I change the weights of one versus Apple, it's going to change my portfolio standard deviation and expected return. Right? It's going to change it at different levels of, these are my different levels of portfolio. As I change portfolio weights, it's going to change my returns versus my standard deviation. Now notice, I'm not going to want to own anything that's below this line. Why? Because standard deviation equals risk. I have to take on more standard deviation or more variance in my portfolio to get more return, right? Now, by taking on more standard deviation, I get more return. But notice, as I get to one, but anything below here gives me the same standard deviation as this, but negative return. So I would never take anything that's below this line. Never take anything that's below this line, right? But I would take stuff that's above the line. Wouldn't want that combination of risk. However, there's got to be a point where this is most efficient, and we learned that through calculus. But notice what else happens. As I take on more risk, I don't get a linear gain in returns. In other words, for every point in risk, I don't get the same return, the same percentage return in increased variance, increased return. So it is a declining return on the way up. It's a diminished return. But that's what the efficient frontier tells me. And almost any time you run these efficient frontiers, no matter how many stocks you have, you're going to find a graph that looks like this. So please pay attention to that. And once we've done all of that, calculated the risks, we're going to get this expected return. Now, there is going to be a point on here that's most efficient. In other words, the point that gives us the best possible return for the least amount of standard deviation. Because remember, if I want more return, I have to accept the greater amounts of standard deviation. If I want more return, I have to accept greater amounts of standard deviation. Return. So for every extra return, to go from 11, 10 and a half to 11, if I'm at 10 and a half, which is here, and I want to go to 11, which is here, so I pick up half a point, but look how much deviation I have to give up. That's what I want to avoid. Now, look, if I'm a risky individual and I want to get up to 12% because I need that to, say, meet my objectives, I'm going to just put on the standard deviation and take the risk. That means my portfolio is going to deviate more. What it really means, if I want to visualize it, is less deviation is going to be the distribution of returns are going to look like this. More deviation, they're going to be more spread out. And I'm going to have to live with more down days and up days. Okay. The code word is risk. The code word is risk. Code word is risk. And there you have it. There you have it again. And then we have to find our minimum variance portfolio, right? So what I said to you is there's a place where I get the minimum variance. That's going to equal a certain rate of return. That's my minimum variance. If I want the least amount of a variance, where do I get it? Well, I have to find this spot right here, which makes sense, right? That's the lowest variance. That's my highest return. Anywhere down here, I get less return for my risk. Anywhere up here, I get more risk for my return. The minimum variance portfolio is the portfolio with the smallest standard deviation. Looking at the graph, it's somewhere between 24 and 25%. And you could use the solver function to find the exact weights where the portfolio has the lowest variance. The portfolio weights in Apple and Cisco that provide the lowest variance portfolio. And I just showed you that. Click on the data tab and then click solver. If it's not present, follow the link to load the solver. I just showed you how to do the add-ins. Do it for solver. We want to minimize the standard deviation in cell B8. While the set objective area, click on cell B8 and click the minimum option. And that's how you're going to get it. So cell B8 is the portfolio standard deviation. And going back to what they asked you to do. It's up here. So the solver function is up here. So cell B8. And then you click on minimum. It is. Okay, I'm sorry. And then you would just Click on it and you'd get that number. That would solve for the lowest standard deviation. Should be right here. Okay, so that's all we're solving for here. And so let's go back. Just to show you how we did that, we go here. Then we want to do rank it against cell B. Solve. Found a solution. Sits right here. Solve for the right weight. So this was already done for you. Okay, so to continue, and once I know what my weight is for this Cisco, I can back into my weight for the Apple since they have to equal 1. At those particular weights, I get my lowest variance. And there's your minimum variance portfolio. What it really shows you is what the efficient frontier is. It's the set of portfolios that provide the most return for a given level of risk and for a given level of risk and is the part of the curve after to the right the minimum variance portfolio. Really important that you understand what this is. It's the shape of the curve should be familiar. The efficient frontier represents a set of portfolios that provide the most return for a given level of risk and is the part of the curve after to the right the minimum is the part of the curve after to the right the minimum variance portfolio. Since we already know the minimum variance portfolio, we can plot the efficient frontier. Okay, so please try to understand what that is. Once again, we know what our minimum variance portfolio is, and it provides the most return by giving the right weights for that level of risk. Okay, going back, right? Once we know what our minimum variance portfolio is, this is the most return for that level of risk. That's our minimum. This is our minimum variance portfolio. This is the most return for this. Note that any portfolios in blue below that are not efficient because they have higher standard deviations and lower returns compared to the minimum variance portfolio, for example. The portfolio represented by the last dot has a return of 9.9% and a standard deviation of 25%. It is inferior to the minimum variance portfolio because an investor can achieve a higher return. So as I said, you can get better returns, but not the minimum variance. The minimum. I'm just printing these for myself. Risk is the key word here. Risk is the key word. Good. Now, how does that fit into the capital asset pricing model? Capital asset pricing model was developed by William Sharp and, among others, Trainer is another famous, and it was developed in response. After they figured out this two security separation principle, right? That people will hold risky and risk-free assets. And once they knew that the capital asset pricing model, if you watch my videos, is essentially the slope of the line. It's the risk-free rate plus the beta, the slope coefficient, beta, times the risk of the market minus the risk-free rate. That's the capital asset pricing model. That's the capital asset pricing model. For example, assume a stock that has a beta of 0.8. The current risk-free rate in the economy is 1.5%. Risk-free rate is the rate that you earn in the bank without taking any risk. It's basically where the U.S. Treasury borrows money. If I go to Wall Street Journal, risk-free rate is traditionally the 10-year bond, which is about 1.655%. So the U.S. government borrows money out to 10 years. It's the lowest rate available, just by way of expression. Okay. And then we just take the beta, and again, watch my video, which is the regression of the line, times the market risk premium, which is what the market would give you in general. Generally speaking, it's the price earnings ratio of the S&P 500. So if the S&P 500, which is a representation of the market, has a price earnings ratio of 10, say for instance, that means investors are paying 10 times earnings for the S&P 500. If the S&P 500 earns $1, investors on average will pay $10. That means the market yield is about 10%. So we'd multiply beta by 10% after we subtract out the risk-free rate, which is called the market rate of interest, the market rate of return. There you got it. That's in the calculation. And when we draw, the security market line is a graph of the capital asset market equation. The security market shows that for required rate of return for different betas. The security market line is a graph of the capital asset market equation. It shows the required rate of return for different betas. Required rate of return for different betas. This is really I have to applaud Rasmussen. Did a great job with this, explaining this. Makes it very simple to understand. We're just plotting the capital asset pricing model. So then we just have to look at different betas, in this case from 0 to 1, and we can see how much return we get, given the current market. Excellent. Excellent job by the school. Right? The capital market line represents a different combination of the market portfolio and the risk-free asset. Or in other words, the required return for every risk level. The implication here is that we can combine the risk-free asset with the market portfolio to find combinations that are superior to the efficient frontier. So the capital market line represents combinations of the market portfolio, everything that's in the market, and the risk-free asset. So it's the required return for every risk level. The implication is that we can combine a risk-free asset with the market portfolio to find a combination that is superior to the investment return. Very, very good stuff. Very, very good stuff. And again, I have to highlight it. I'm going to save it as a compendium for future classes. Very good stuff. Excellent. Very good stuff. CML represents the risk premium of the efficient portfolio as a function of deviation. SML depicts individual security risk premium as a function of security risk. Cannot stress this enough, how important this is to modeling financial information. I cannot stress it enough. And the Sharpe ratio, create the CML, we first find the Sharpe ratio. The Sharpe ratio measures the expected premium or excess return earned by an investor divided by the risk taken. So the formula for the Sharpe is the risk of each security, RI, minus the risk-free rate over the standard deviation, or the risk premium for investing in stock I over its deviation. So we know that this is the excess return we're going to earn And this we're going to divide by its standard deviation by getting our ratio. Again, cannot stress enough how important it is that you go through these very carefully. And I would suggest saving this as a guide, because if you're going to continue to study finance, you're going to be dealing with this a lot. And this is going to help you to figure out why stocks trade at certain levels and how to put together a portfolio of stocks, frankly, that would give you the highest return given a certain level of risk. So here we see that this portfolio has a variance of 0.697 and has a standard deviation of 26.4, right? The expected return is 10.96. To get the Sharpe ratio, see if I have it here. Here's the security market line. Here's the capital asset model. Here's the capital asset pricing model. The Sharpe ratio is a function of the expected return, risk-free rate. The Sharpe ratio is the return minus the risk-free rate divided by the standard deviation. Return minus the risk-free rate, or the market risk premium, divided by the standard deviation. And to find this line, here's the efficient frontier, here's the minimum variance. To find the capital market line, we can either plot it. To find the point on the line that's most efficient, we do it by calculus. We find the first derivative. And using solver, we find Cisco's weight that maximizes the Sharpe ratio. We now have to create the market portfolio. We compare with the risk-free asset at various weight levels. That's it. That does it. So once again, we can end our, well, we'll talk a little bit more, but that's really how you put together how you relate the capital asset pricing model to the rates of return. We want to know, once again, the levels of risk for each set of portfolios, and then we find the capital market line, going back. That's going to give us the capital market line using the solver. Going back to our spreadsheet, solver, it already does it for you. And if you look, we're looking for this point in the line, 79%, or 24.57 return, given that portfolio expected return. That's the minimum variance. But if we want to find the point tangent to the line, we do it through calculus. Here we could do it through the solver function. But you can plot the capital market line to find the point tangent to the curve, which would give you the most return given a standard deviation. There's a risk-free asset. There's the rate of return. Any questions? Well, you're not, this is not a live, I mean, well, it is live, but I don't have you here. But that's how you do it. All right. Okay, so we're gonna stop here and hopefully, you got, hopefully this is illuminating and gave you a good view of, um, stop sharing. Gave you a good view of what we need to do, and again, include stop recording. Include the keyword, which is risk, and contact me with any questions. I'm more than available and willing to help. Thank you.